Hello, everybody. Welcome to one more class. Now we are gonna learn a little bit of vocabulary, really basic vocabulary, right? This is banking vocabulary or financial vocabulary. It's just basic. I'm not gonna teach you anything about accounting, finance, or investment here. It's just for you to learn the basics, really basics, and actually to understand the definition of a few institutions or terminology or basically English words or I'm saying English words because we are studying English, because I'm teaching English to you, obviously. Because these words they also exist in Portuguese, in Spanish, in French, in Italian, in German, in every other language, okay? So let's go. Financial institutions and accounts. So there is three different institutions, which is building society, bank, and credit union that they have a slightly different. Cool, and it's pretty much who owns that and where the money goes to. Okay, so building society, for example, building society is nothing else than a member-owned financial institution that provides banking and other financial services, such as mortgages and savings accounts. Unlike banks, they are owned by their members rather than external shareholders. Okay, a bank on the other hand, is a financial institution licensed to accept money from the public for safekeeping, lend money to borrowers, and provide other money related services such as processing payments and offering investments. Banks act as intermediaries between those who have money and those who need to borrow it. In other words, between depositors and borrowers, making a profit from the difference in interest rates. Making a profit from the difference in interest rates. Okay? So they buy cheap and sell more expensive. Basically, that's what they do. So, credit union, a non-profit member-owned financial cooperative that provides services similar to a bank, including savings, checking accounts, and loans. They typically serve a specific community or group and return profits to members through better rates and lower fees. Okay? So to better understand the difference between them, I left an example here and I will just play this video here. It's just a 6 minutes video. It's really quick. It's really quick. I will play now. I will play it now, and I want you to pay attention to what that is. Cool. And then it will be extremely easy to understand. And after that, we will go back to our sheet. Okay.
Banks, building societies, and credit unions. Explained. In this video, we're going to look at what is the difference between a bank, a building society, and a credit union. Those financial institutions that people sometimes find difficult to understand. So firstly, let's look at the ownership type and where do the profits go? Because this is a main fundamental difference between a bank, a building society, and a credit union. So in a bank, as you can see there, where it says TSB, they tend to be privately owned by shareholders. Shareholders will buy shares in the bank. As a result, they will want to return for their shares in the form of a yearly dividend. That is a share of the profits. The bank will make its profits from its customers, so the people that lend money from the bank, and also people that buy services from the bank. So that is their main focus. In the middle, we have our building society. Here is the main difference. Unlike the bank, this is owned by the members. So every single customer is a member of the building society. All the customers, all the members get one vote and they get a share of the profits at the end of each year. They get to vote on how the organisation is run, but they also get a share of the profits, which is normally called a reward or a bonus at the end of the year. Now, this slightly differs from a credit union because they tend to be run by not-for-profit organisations or charities or community groups, for example. In these, every customer gets a share in the organisation and gets a vote on how it's run. They also get to say and suggest ideas how it can benefit the local community they work in. But unlike the building society, the profits don't go back to the members, they get reinvested back into the credit union, allowing it to offer loans at a lower rate. So, what about location? How does that differ? Well, your banks tend to have a large number of locations all over the UK. That for the customer means they get easy access to money regardless of where they are, where building societies tend to be located regionally across the country. This can actually limit the access if you are needing access to your money quickly, for example, and you're not in the location you normally are. Because in a bank, you tend to be able to go anywhere and find a local bank. A building society, once you step outside that regional location, you're going to find it difficult to access your money. Credit union tends to be located even more tightly knit in local communities. It could be run from a community group, for example, or from a church building, or maybe in the school building. And they have very restricted hours. So that's going to limit the access that you get. And obviously, because of those restricted hours and those specific days they open, that's when you'll be able to get access to your money. So what financial packages do they offer? Well, the banks tend to offer a wide range of accounts, including savings accounts, current accounts, loans, mortgages, insurance, and many other financial packages. There is no doubt that banks offer the widest range of products, whereas your building societies tend to offer a limited number of accounts, typically specialising in savings, loans, mortgages, and they sell some type of insurance. However, many building societies don't offer a current account. They specifically focus on savings and trying to lend mortgages. Now, your credit union is even smaller still. That will offer a really select number of accounts. They tend to specialise in offering savings accounts and loans. And the loan amounts they offer are much smaller. So the banks will tend to offer large loans, just like the building society will in the form of a mortgage. You would not be able to get a mortgage from a credit union. So how do you access your money and how does that differ? Typically, the banks will provide a debit card, and that's going to allow access from cash machines and branches all over the UK. In fact, you can use nearly any cash machine that you would find because the debit card will work across that link network access, it's called. Building societies, on the other hand, tend to use a passbook, which is how you would get access to your money. A little book that you hand over to the counter, they stamp it and they give it you back. So the money can't be normally withdrawn from a cash machine. It tends to come from the branch. So again, it's more restricted because you've got to find a branch of that building society to get access to your money. Now, credit unions typically have what they call a logbook, a bit like a passbook really, and that's used to record the transaction. So any withdrawals will have to be in cash, but if you're going to pay off a debt, for example, it gets recorded in that logbook how much you pay back, and you can clearly see what you're doing. But again, you've got to go to the credit union on those set days. So again, much more restrictive than the banks. And finally, let's have a look at what protection do they provide. Well, actually, all of them are the same. Every single one, a bank, a building society, and a credit union, offers protection on your savings, guaranteeing them up to the value of £85,000 under the FSCA rules. If you're not sure what that's all about, I have a video on that that explains how those rules apply. And what it basically means is that your savings are going to be guaranteed up to £85,000. So if the bank, building society, or credit union was to go bankrupt, the first £85,000 of your savings would be protected. Okay, hopefully you now have a better understanding of banks, building societies, and credit unions. Ideally, you'll now be able to answer the question, if I posed it, what are the similarities and differences between a bank, a building society, and a credit union? If you can answer that question honestly, then you understand this topic. If you're still unsure on that, maybe go back to the video and watch it again. That'll probably help you to understand the difference.
Cool. So that's the definition between them. That's the definition among them, right? Look at this. There is a difference between and among. Cool. So there is a difference between building society and bank. So there is a difference between two things, or there is a difference among them, right? Meaning more than two. Okay, building society, bank, and credit union. Okay, so that's it. Yeah, if you did not understand, just click on this link and then watch the video again. And yeah, that's pretty simple. Cool. Let's move on. Bank account. Bank account is a financial account maintained by a bank or other financial institution in which a customer can deposit, withdraw, and manage their money. So banking, there are many financial institutions and companies, digital companies, where you can just open your digital account and then you can just transfer the money from the bank to these other institutions. For example, there is one company called TransferWise. I'm pretty sure you know them. There are others as well. But with TransferWise, the good thing about TransferWise is that you can transfer. Now it's Wise only. It was TransferWise before, but they changed the name probably because I have no idea. Right? So you transfer the money from your bank account to TransferWise, and then from TransferWise to other countries, to your bank account in other countries. Right? So they do this transfer, then they charge a small fee to do that transaction. The services are really good. Okay, so you can open your bank account at the bank or in other institutions, financial institutions. Okay, so now savings account. Savings account is just a type of bank account designed for holding money over a long term. These accounts typically pay interest on the balance, limit may limit the number of monthly withdrawals. Okay, so in Australia, for example, I think that when I was there, I had five. I could withdraw 5 times. Right? Some other banks they allow 10 times, or yeah, that's what they do. Checks everyday check everyday and transaction account. An everyday bank account used for daily expenses, such as paying bills and making purchases. It typically comes with a linked debit card and has no withdrawal limits, but often pays little to no interest. Cool? So that's not a good idea to leave the money in your transaction account, neither in your savings account. It's good to buy shares of stock and then you will own a little bit of money on a monthly basis. Cool? Transactions and payments. So a scheduled transaction is a future dated or recurring payment set up to occur to happen automatically on a specific date, such as rent or utility bills, such as rent or utility bills. But there is another way on how the scheduled transactions are used. Companies normally they schedule the salary payment. So when you receive your wages, it means that someone in the team, in the team, from the company, scheduled that transaction, perhaps a month before that happened, or not a month, but a week before that happened. Cool. So this is a scheduled transaction. You schedule today, and the money will get out of your bank account in perhaps 2 weeks, 3 weeks, 4 weeks time. Cool? Whenever you want. Bank transfer, the name is pretty much self-explained. So it's the process of moving money electronically from one person's or business bank account to another. So if you have, I don't know, $10,000 in your bank account right now, and then you want to BRL if you're in Brazil, and then you want to transfer from from your bank account to somebody's bank account, this is called a bank transfer. That's pretty easy. Credit card, it's a card used by a financial institution that allows the holder to borrow funds up to a certain limit to pay for goods and services, with the requirement to pay the balance back with interest if not paid in full by a due date. Cool? So if you have a credit card, it means that you can use your credit card to buy something now, and then it will be paid on perhaps the next month. On perhaps next month. Okay? So this is what a credit card is. If you are over 18, you already know, which I am pretty sure you are. You probably have credit cards. Use it wisely. Online payment, any payment made over the internet using a digital service, often facilitated through a bank's app, website, or a third-party service. Cool. That's what online payment is. Account status and activity. Available balance, it's just the amount of money in your account that you can use immediately for withdrawals or purchases. This excludes pending transactions that haven't cleared yet. Cool. So it's pretty much the amount of money you have in your bank account. That's all. Current current balance. Current balance. The total amount of money in your account at a specific moment, including pending transactions that have not yet been finalized. That's your current balance. Purchase is the act of buying goods or services using funds from your bank account, debit card, or credit card. So when you buy something, you are actually making a purchase. You are purchasing something. So purchase is the act of buying something. Identity and customer roles. So proof of identity or ID card is just an official document such as a passport or driver's license or the ID card. For example, in Brazil, we have a document called CIN, CIN, which is card national identity card. Yeah, that's interesting, and it proves that you are you, and it shows your name, it shows your age, it shows your your tax no tax tax number, the number you use to pay your taxes or to declare your taxes as a person. Cool. And yeah, it's a document that has a document that it's a card that has all your data, your personal data. Okay, and then you need to use this to open a bank account, or whenever you go outside, you need your ID to prove that you are over 18. Cool, that you have reached your majority. So what's your name? What's your name? Why is this here? Standard question used by bank staff to verify a customer's identity or a start application. What's your name? What's your name? What's your address? So they're just basic questions that people will ask you when you go to the bank. And if you actually go to the bank to open a bank account, they will ask, "What's your name? What's your address? May I please have your ID?" And to open a bank account, sometimes you have to have a few payslips, and that's all. Banker, a professional who works in the banking industry, often managing financial risks, providing advice, or overseeing bank operations. So, bank teller, a frontline bank employee who handles routine customer transactions such as deposits, withdrawals, and cashing checks. Bank manager, the individual responsible for overseeing the daily operations, staff, and overall performance of a specific bank branch or department. Personal loan, a type of loan intended for individual use, not business, such as for a car, home renovation, or debt consolidation, typically repaid in monthly installments over a set period. So, so these are just the vocabulary we are gonna be using in our essays, cool? In our writing. So of course you're not gonna write only. You're not gonna write an essay only. You're gonna write essay, email, a narrative, a few different types of writing. Cool. So thanks for watching. If you liked this lesson, please just hit that like button if you are on YouTube and share with your mates. Okay? I will see you on our next class. Bye bye.